I had a little distraction this weekend that I would tell you this might not be the best one to sit through. So if you're a multitasker, this is a good time to multitask on the survey 17.
18.
18, sorry. So what are the odds of another positive year? We live in a messy and sloppy world right now, and it begs the question, can we have back another positive year in the US equities after back-to-back 20% plus years? I think the answer is yes, but not a 20%er. I think it will be more along the lines of a 8 to 12% year in the markets, which would be right in line with historical norms. But we'll give you the case for and against and what we're seeing. So this was coming into last year where the street saw expectations for 24, and they weren't really very accurate. We ended at the year at 58, at 5,800 basically. But you can see it was a lot of smart people really whiffed on this. So it's just a reminder how hard it is to forecast in a world that's going through so much change so fast. But you get a sense the average expectation last year was, around 48.50, 48.75. So pretty big miss there. What worked? We know that Bitcoin took off. We know the Mag 7 continued to do well. Gold continued to attract a lot of interest. I just saw today that China picked up their gold purchases again this month. So they're continuing to add to their gold holdings and their reserves. So I think you know the reasons why these things worked. What's interesting is the bond index is kind of flattish, but you're getting reasonable returns right now in terms of yield in bonds in many places in the world. So I think that there's some shifts going on that are worth looking at. The other surprise was how big the big companies have gotten and how fast they got there and how big the changes are. Just to give you a sense, in 2010, Apple had a market cap of about 110 billion. Google was 190 billion. Amazon was at 81 billion. Nvidia was around 8 billion. And Microsoft was around 238 billion. And most of you saw that Microsoft announced that their CapEx spend for this year will be 80 billion, up from 56 billion this year. So these guys have not only rock solid balance sheets, but incredible cash to put to work. Plus they have the ability to cut back on spending in other areas to redirect it, as we saw Meta do, and what that did for their returns as they had their year of efficiency. So there is some big upside still in these companies, and one of the issues is for the markets is, will M&A pick up? And the question is, what will the role of these guys be in M&A as well as others? So we'll talk more about the market and what we think is happening this year. But to put it into context, how has the last 2 years been since the low in October of 22 to where we are? And it stacks up kind of on the low end of bull market runs, which would give you the sense that as much as things have moved very quickly, there is more to go, even with the problems in the world. So we'll get to that in a sec. So the take on this year, starting with the Trump effect and the markets, I think we're going to see reasonable growth this year in the US and globally. I think the US is going to do about a 2.75 growth rate. Inflation is struggling to get to central banks' targets of 2% in the US and elsewhere. I saw Germany put a 2.9 or 2.8% CPI. The US is running around 2.5 to 2.7, maybe 2.8 after the next numbers released, which means monetary policy and the expectations of cuts may be disappointing for a lot of people. I think the fiscal policy is the one that's going to be the real challenge for people this year, whether it's the US fiscal policy or China or Europe. We're looking at a real challenge for governments where the demands of the population are greater than the abilities to deliver and meet all the needs for investments that the governments need to make. both to stay competitive and to deal with their own financial issues of the last 15 years. So we have a lot of weak balance sheets in governments and a lot of spending demands on them. And I think that's going to lead to a bit of a shift in the US, at least, where the federal government will spend, but DOGE is trying to lower their spend, which means the corporations and consumers are going to have to pick up. I also think in the US, it means state and local governments are going to have to spend more, as the Fed will still spend a lot. They're going to increase spending in a couple areas, mainly defense as one of them. But I think they're going to need to be somewhat more restrictive than they've been over the last bunch of years. And I think that means the shift has to move back to the private sector. And what does that mean for us going forward? So as we look at this year's forecast from the street, they are much more optimistic. And that begs the question, were they too pessimistic last year? Might they be too optimistic this year? I think the ranges are reasonable for the growth expectations that I see for the market in the US. Ed Yardeni, who we had on a call last month, that some of you joined, is calling for 7,000 on the S&P. He was among the most accurate forecasters last year, and he thinks that the world is just a little too pessimistic about the opportunities in the US, and we tend to agree with that at ARS. We'll talk more about where the challenges are. But I think the one thing is for the markets is, does the current conditions allow the Fed to cut rates as much as might be priced into these expectations from the street? And what does that mean for investment in this year? And I would say that I think if you're counting on Fed cuts, I would revise my strategy. I would look for those that can stand alone on earnings growth to drive them going forward for returns this year. I think the expectation of too many rate cuts has been, the street's been out of whack with that for the last 2 years. I think their expectations are still too aggressive. What happens under different growth rates? Because what kind of growth we get matters. And as you can see, historically, low growth gets high stimulus. The kind of 0 to 2% growth is where central banks and fiscal policymakers are trying to decide how much they should do. And that's why you tend to get that kind of effect. And when they see it going down towards 0, they start to act more aggressively. I think we're in the 2 to 3% range for the US, and I think we're going to be in the low threes globally. So I think that sets up for a pretty healthy S&P return environment into this year. But the two big $2 trillion questions are, will the market broaden out meaningfully, and will big tech, the Magnificent Seven who are doing all this spend, start to get a return on it, or when do they get the return on it, and what happens to their growth rates? And I think these are the issues that are going to really determine what happens in the markets this year. Obviously, there's a call for a broadening out of the markets, but I think there's a significant number of companies that have too many debt and net interest cost issues and not enough growth to compete. And I think that's going to continue to lead to a have or have-nots. That doesn't mean the market doesn't broaden, but I don't think it reaches those in greatest financial need. So I think we could have some real distress. I think the other thing that you're going to see is a lot of M&A activity where you see slices of low-performing businesses carved off and given away to people who can get a better return on those investments. And companies will take that money and either reinvest it into lowering their debt levels, getting their interest costs down, or making the CapEx investments they need to make to compete. But I think these are the two of the biggest questions facing the markets today. I think the other one is what the Fed does. And, we had Fed cuts of about 1% since September, and all we've done is seen rates start to move up. And that's putting some pressure on the markets as we come into this year. And it's the housing that's feeling it still. And that is one of the Achilles heels for the US right now, is what do we do on housing? So I think that's one of the issues we're going to have to focus on, is the 30-year fixed has moved up quite a bit in the recent period. The US 10-year is at the highest level in a decade, and the European or the German 10-year is also at the highest level since 1998. So we are starting to see some reversal of the interest rate declines that we saw last year, and I think that's going to be a challenge. Demographics are a problem. We talked about this last week, and this is actually the worker shortages in Japan and what their gaps are over the next couple of years. And there's an institute in Japan that's the Research Center for Economics and Society on Aging. And they came out with a report this week that said in 695 years, which I know is a long way off, there will be, according to their projections, one child in Japan under age 14. To give you a sense of how they're projecting the decline to go, this is what a system looks like when their fertility rates are too low and they don't have immigration. And in fact, there was an announcement.
Stephen, can you repeat that quote on the child under 14
yes.
again?
So over the next, in the next 695 years, I think it's by 2725, Japan is projected to have one child under age 14.
There has to be a lot of assumptions embedded in that one.
There are, but Mark, step back for a minute, because I thought that's insane number. So what does it really mean? Yeah. But there was an announcement today that Japan is actually looking at subsidies for fertility. They're actually going to, including epidurals for women so that the delivery of a baby is less painful, so that they can do anything they can to increase the birth rates there.
Isn't China doing that already, Stephen?
I believe they are. And actually the China numbers are equally staggering on the other end. I think by 2030, 400 million Chinese will be 60 or older. And that is equivalent to the total populations of the US and the UK.
Already over 50.
Yeah, are going to, they'll be over 60 at the end of this decade. Will be 400 million people in China.
They're already over 50 now.
Yep. So we got real issues in demographics coming, and that's going to put even greater demands on productivity. And I think that's the key to offset both inflation and labor concerns, is getting the productivity move right. And as you can see, we've struggled in the US with productivity. This is from the US productivity chart. But we believe that what's going on in technology, what's going on in AI, will allow us to get back to a higher level of productivity, shifting up towards the 3 to 4% level. And if we get there, that could be a really significant boom for investing throughout, because we would be doing a lot more with a lot less, which means companies have more to spend and more. It leads to higher wages, but it also offsets the labor issues that we're seeing. So I think that's another issue that we have to keep an eye on. But we believe productivity is about to reverse the trend that we've seen in the US and start to move up again. It already is starting, but we think it can go higher and be a pretty significant offset to some of the challenges we're facing, including the tariffs and other issues that are coming in. Mm-hmm. And then lastly, we talked about this last week, but there's a lot of dry powder with a lot of options now. You have, 5% yields or higher that you can get, move into private credit. You can move up into much higher returns. And as the push to democratize private investments to the masses moves forward, that means a lot of money. This money can be put to work in equities and fixed income and private investments throughout. But I expect that money will not sit long and will start to move, because I think people were waiting for the election and waiting for some of the problems that we're working through to get through. So final thoughts, there's a case for staying home and a case for going global. We lean towards the states for—
Stephen, that's another question. That's a big number. Can you go back to that slide?
Yep.
Do you have a composition of the holders?
I don't have those right now, Mark. I suspect it would be, if I had to guess, it would be about 4 trillion or so retail. Maybe a little less, maybe 3 trillion retail. 3 to 4, it's about half, I think, between retail and institutions, corporations, and the like.
Okay, sorry, carry on.
So stay at home or go global. We believe the US is the best house in an imperfect neighborhood. I think the I think the domestic policies are going to be unpredictable for the near term, and you'll see a lot of statements that send people on chasing different things. But remember one thing about Trump, he cares mainly about his reputation, his legacy, and a lot of that he rates on how the market does. And I think a lot of his policies will be driven towards that. You already saw a little bit of a shift with the immigration issue where Musk was pushing for greater H-1B visas, and some of the hardline Republicans were in favor of just full mass deportations and shutting the borders. And I think you're getting a little bit more reasonableness into some of the policies, particularly around one that we'll talk about in the next couple of weeks, immigration. But I think that's a big one. I think the deregulation is another element of that. And while immigration, we're going to have people close the borders and have people move out, I think it'll be a much bigger challenge for them to get the mass deportations out. So I think that the concerns on that might be overblown in the near term. And if we get our policy right, I think that will set us up well for the longer term. I think deregulation costs us about 3% of GDP of new regs that were put in under the last administration, and they'll work hard to lower them. I think energy independence and growth are part of the advantages that the U.S. has over others. Reserve currency status, innovation, and our resilience are other big advantages. And I think the resilience is one of the things that even the strategists underplay, and that's why I think they got it wrong last year. They were too negative and undercounted what the U.S. could do. On the other hand, outside the world, there are real competitors, and China is among the leaders of them, and they're bringing a lot to the table. They dominate so many of the most critical industries going forward that we have to be very cognizant of where they are and what they're doing. I think Europe has had a lot of struggles, but I think they're getting closer to a turn there. I think they have big policy issues that they have to get through, but that doesn't mean that the markets don't start anticipating in advance of some of the opportunities. So while I've been exceptionally negative on Europe for some time, I do think there's a turn coming there that can help us get back on track. However, fiscal space is limited. Changing terms of trade are going to be a problem. I think the needs are greater than the spending available for governments, and that leads to a lot of populist movements. That's why we saw so many incumbents thrown out this year. And I think the conflicts that are both global and domestic will restrict growth, and that puts even greater pressure on governments and on economies. So I also think the lower valuations may attract buyers, but I think they may be a value trap in a lot of areas. So I would be careful and be very selective wherever I'm going globally. I think energy, industrials, materials, tech, and financials are the place you want to be. In the US, I think healthcare, biotech is going to continue to work, but it'll be challenged, one, by rates, and two, by policy uncertainty in the near term around the Trump administration. So we're optimistic, but guardedly so as we move into the new year, Mark. And I think there's opportunities to make money, but we need some good decisions, and we need leadership to act the way they're supposed to. Whether we get that or not is a big question. So with that, I'll open it up for conversation.
Okay. Thank you, Stephen. Questions, comments?
Stephen, thanks for that as usual. You historically look back at how the S&P did for 2024. Was this, but the slide there, I know you had split it by the Magnificent Seven and the other 498. What's the street consensus for 2025 in terms of S&P? Where's it going to end up? Percentage increase.
I think the numbers I showed from the chart, let me find it here, for their forecast for this year would be about they're really projecting, if you look at the median, we ended at 58.81 and they're projecting 67. So I think that's about a 12 or 13% return. My math isn't as good as the people on the call. But I think that's a reasonable expectation. It's in line with what we've done historically. So.
Hey, Stephen, just out of curiosity, how much of the kind of current debt discussions, like national debt discussions and short-term paper, you index like the, 10 years now at, exceptionally high rates. Like, how much of the national debt conversation start to factor into the general economy?
I think
Right,
the
do you
first
think?
place it starts is in Washington with the Republicans, because they have to decide how big a deficit they can live with.
You got the debt ceiling conversations coming up like in the next 2 weeks, right? Right
Right.
after the inauguration.
Right. And they may not actually address the debt issue in that, which will put the street on alert. And I think the bond vigilantes have already started to send a message with the move up in rates since I got to find that chart first, but in the move up in rates since the Fed started cutting. I can't find it. Well, just gives you a little bit of a sense, but the Fed started cutting in September, and you can see what mortgages have done in that period. And we had a similar move in treasuries are up about 60 basis points. So I think the bond market is starting to send that message that they're worried about debt and deficits. And I think Congress is also worried about it, but doesn't know how to act with Trump right now. So I think Trump has to actually start to care about it. And so somebody has to be in his ear that it's going to matter. And it may be the market, or it may be the far right just saying we can't take it anymore.
I think that's going to be the sleeper that no one's really putting front and center that could actually drive a lot of, negative return pressure.
Although, but I think it drives negative returns if you're counting on multiple expansion, right? And there are a number of companies that, if you look at the small caps in the US, 43% of them, I believe, don't make money. They need lower rates to deal with the environment they're in, and I don't think that's coming.
Yeah, debt service and everything else too. It's just an input to a whole bunch of other outputs. So
Yep. Yeah, that's right.
Thanks.
Yep.
You're welcome.
Andy, hand up.
Yeah, so Stephen, I made a point last week that I thought keeping short rates high was inflationary, but beyond that, I agree with you. They're not going to cut them, but what's missing from the equation nobody's talking about is that the Fed took their balance sheet from $4.5 trillion to $9 trillion, and that we had that whole inflationary spike. The balance sheet has rolled off from 9 trillion to 7 trillion in recent times. So you have this offset between you could lower short rates and you're rolling off your balance sheet and you're not actually adding liquidity. And so if you then go back to the haves and have-nots, as you pointed out, the haves are the ones that have no debt service. They just have cash. Now they're getting 5% on their cash instead of 0. But if you lower rates, then how does that affect the market multiples of Magnificent Seven? So those are all dynamics that I just don't think people are talking about enough.
No, the one interesting thing that you just mentioned, though, is the FANGs, the Magnificent Seven, what they did, though, in zero interest rates is they went and borrowed long at 2% and are now sitting on cash at 5%. And they did that to partially pay their dividends when they were introducing their dividends. So they're actually, they played it the way you should, arbitrage the market. They arbitraged it right.
Yeah, Stephen, Apple has 1.5-year, 50-year bonds they issue. 1.5% 50-year bonds, but I'm not counting that. That's not debt service.
Right. But I think you bring up a good point. I think the market is starting to worry about not only that, but the level of reserves in the system too. You start to see more conversations about that. Are they getting to levels that are too low? Have we taken too much liquidity out of the system, given the size of the economy from where it was before? That's another issue that's going to come up.
It's an experiment that's never been done before. The Fed doesn't know. Nobody knows. It's never been done.
Fair enough. Bill?
Right. So just to answer your question, Mark, I did some homework for you, Stephen. The breakdown on the money market funds is roughly 60-40. So 60% is institutional and 40% is retail. Clearly, there's different motivations and investor habits between those two groups. So it'll be interesting to see how that money gets deployed or not.
Yep.
Yes, in a rising rate environment, the institutional money runs.
Yeah.
And the other money stays, retail money stays.
Yeah, and I think with the normalizing of the yield curve, which is kind of surprising, that we've started to see that, more demonstrable now. I think retail is slowly going to be moving out of it, but still people are getting rates that they haven't seen in years. So I think just the fact that you're getting positive income out of money market is a big deal.
Chris Mayo?
Thanks, Bill.
Thanks, Bill.
Yeah, my question related to China. I mean, if you're roughly moving half of the workforce out of the workforce in China, I'm assuming to make jobs for younger people. But what does that do for China's economic engine and the manufacturing base for the world?
I think China's already started to see the manufacturing shift on the lower end. They want to move up to higher end manufacturing so that they can pay higher wages. And I think you're seeing the lower cost labor, or has that shift that started a couple of years ago to Vietnam and other nations where they were becoming the lowest cost manufacturers.
Your
I
screen.
don't know how long that goes on for, but I think that China does have a demographic cliff that they won't have to worry about in the near term. They probably should worry about it in the near term. It's too late for the problems that they've created for the short term. I think they have to figure out where do they go in the intermediate term. And because they can play the long game differently than the US can, I think it's just a question of, what do they do to fix the problem? And one of them is culturally against what China's about, which is big immigration. So I don't know how China's going to deal with it, to be honest with you. I think they'll continue to do fine, but sooner or later the bill comes due.
So Adam, I was just making a plug for Survey 18, please. If you all could participate so we can have collective anonymous intelligence. Put it in the chat. Adam?
Yeah, quick question, Stephen. How do you play this demographics trend? I put a couple of reports on the chat, the UN demographic report, which is quite interesting. China going from 1.2 billion to something like 600 million. And I wrote about this regarding Russia as well, dropping down to something like 80 million population. So how do you play that in today's market?
I think it's productivity, it's AI. It's the things that are going to substitute capital for labor is how you play it. That's why AI is so critical to what goes on going forward. And then it'll be quantum and all the innovations that we keep coming up with. That's how you play it. And I think that's what people miss, Adam, when they were looking at the markets. When they look at the US and when they look at the markets overall, is they don't appreciate what constant innovation does. Even though we have benefited from it every day, I think we take it for granted. And I think the innovative power that the US economy puts out and the entrepreneurial spirit and what follows through that is so critical. And I think you can sum up the world's problems from our trip to the West Coast last year, Mark, when we go to downtown San Francisco and see Union Square in decay, and you go to the Valley and you see the great optimism that's coming from the Valley.
How about the new mayor of San Francisco? Did you see that?
No, I didn't know it.
Anybody in San Francisco with insights on that? I mean, basically, he's I don't know. It feels a little early 20th, Giuliani-like. Clean up the streets.
But I think the contrast, I think, is really what I was trying to stress, Mark, is if you drive, what is it, an hour, you hear a completely different view of the world, which is all full of hope and optimism, and everywhere else it's full of pessimism. And
in New York, that could be 5 blocks.
Yep.
But
But I think that's the issue, Adam. I think it's innovation that's the answer, and immigration for countries that want to take this seriously and recognize that they have an issue. You know, I think the US's problem isn't with immigration isn't the number, it's how they're coming in and who we're getting and what needs we're filling. And I think a structured immigration policy that allows for skills of different jobs that need to be filled and with quotas around that, to get part of the immigration through, get the H-1B visa number way up, and then move on to dealing with the political asylum seekers. I think that's the way you do it. I wouldn't lower the number of immigrants we have coming in. I would right size it and figure out how to get the housing right. But I think that's what's going to be at play, is immigration policy is going to be one of the answers to your question, Adam, as well.
Yeah, I agree. Thank you, Stephen.
You're welcome.
Other questions, comments?
Yeah, Stephen, I agree completely on your immigration H-1B thing. One of the things that's happened is the H-1Bs have been gamed by large tech companies.
One second, that sounds like Duncan. Duncan, okay. Mute you.
Duncan, mute yourself. There you go.
I got
Anyway,
it.
so these large tech companies are just throwing massive applications of H-1B visas and getting about 50%, where we should be giving them out to Yale PhDs that are being forced out of the country since there's not enough H-1Bs. So the H-1B program itself, as Stephen sort of alluded to, needs to be revamped. But I think it's a very important program that we're creating a brain drain by not reforming it.
I don't know who's on the call from Seattle, but several years ago there were billboards in Seattle saying, if you can't stay in the US, we'll take you up here. They were looking for, all the tech companies were putting hiring boards up for students that were leaving, and they would accept them in Canada. Now Canada's actually changed their immigration policy to be more restrictive because they have a housing shortage as well. But housing is going to be one of the big issues that, to Adam's question, in the short term, we have a housing shortage. In the long term, we may have too much housing for what we have. So be interesting to see.
There's only 85,000 H-1Bs a year, so that's not going to move that needle. But the rest of the immigrants.
Is that undergrad and graduate? Is that total?
Yeah, I think so.
Yeah, I think it's 65 undergrad and 20,000 grad, and we should put that up at a much higher level, 500,000 or something like that.
Wanda, how did you come to the US?
As a grad student.
Yep.
And, there was a process when Poland had the martial law imposed that helped in the application. Stephen, I'd like to get your take on what we can expect in the next 4 years of this administration in the space of climate investment, impact investment. So on one hand, we have those nationalistic protectionist policies all around the world. On the other hand, we have climate events, that cost more and more money, and insurance companies, insurance space is screaming about that. And the demographic trends that are impacting economy. Do you see the full retreat from the rhetorics of impact investment, climate mitigation, or will there be a mask effect in the policies? Thank you.
I think Trump's going to blow with the wind in this area. I think he's going to do whatever is in his best interest, or and what he perceives as the U.S. best interest, which is leverage our energy advantage as a political tool. I think that's a short-sighted approach to it, but we're in a world where people always act in the short term first. So I think those who are big on want to see more spend on climate. I think if I had to guess, the IRA will see some cuts to clean energy provisions and as a use to allow the tax cuts to continue. So I think that some of the climate initiatives will take a backseat in the next 4 years. And I think that puts more on the public to do it and corporations to do what they think is the right thing.
Thank you.
Marius.
Hey, Stephen, thank you. I just had just wanted to get your perspective. I was reading in the Bloomberg this morning that earning yields on S&P are less than the yields on the triple B credit, which usually, that negative spread usually indicates stocks are expensive right now. I guess, what's your perspective on that, and where do you see things as it relates to the equities?
I think the markets are expensive. I mean, they're definitely not cheap by any measure. But if the US can get the growth that I think they can get, and if we can manage the deficit better, I think it's reasonable to move forward the way we can. I think we're in a spot where it really comes down to earnings growth there for the companies, but it's going to be very distorted too. The big are going to keep driving the growth, but I think overall, I think the U.S. is going to continue to push forward. I think you'll see bankruptcies continue to rise, but that's part of the normal process in the U.S. of purging the system and getting new entrepreneurs in.
Thank you.
You're welcome.
Monty, you had your hand up before.
Yes. Actually, it's interesting that you mentioned bankruptcies. One of the questions I had was on corporate debt maturities upcoming. Have you looked at that, and how much potential for increases in defaults would you think is possible, especially given the higher rate environment we're in?
I think it's a real issue for a lot of the weak balance sheet companies right now. I would be very concerned about going into companies that are too highly indebted in this environment, because I think what you touched on, Manny, is without the Fed support, which I don't think they're going to get to the degree that they need it. I think it's going to worsen the divide between those who are doing well and those who aren't.
I think it's interesting that it's one of the reasons why some of the tech guys actually, are not as sensitive to interest rates, just because they have almost no debt relative to their kind of earnings.
Yeah, and they can finance regardless for years what they need to do. I mean, you just think that the number of Microsoft spending $80 billion this year. In 2010, when we were looking to go into Apple, the question we had was, can Apple grow 10% that year to get from 100 billion to 110 billion? How hard would that be? And now you're talking about, their spend is going to be more than that. It's crazy. So I think the scale of these companies is so big that we have a hard time putting it in perspective when it's bigger than the markets of countries individually. I think we lose sight of that. And I think it's really important to keep that in mind. I think beyond that, though, I think you go down to the next tier of quality companies is how you have to play this. And that's where the broadening out is going to be, is after the 7, it's going to be the next 70 companies, not the next 493. And how do you find the winners in that?
Thank you.
Adam?
Stephen, what threats do you see to the U.S. economy given the collapse of a lot of the Western liberal governments that we're starting to see with Canada, Germany, France? Many of them are struggling. What are the threats there to the U.S. economy, if any?
Well, weaker global growth hurts the U.S. Because we are both consumers and producers. And we want to produce more. That's why we're bringing manufacturing home. So it's a strain on the global system. And what's interesting is it actually works to strengthen the U.S. It's driving capital to us as they continue to weaken. That's why our case is, at least in the near term, stay home. But look for opportunities to broaden out because I think some of the markets should be getting closer to bottoming around the world. But there are real issues, Adam. There's no doubt about it. And I think one of the big risks is the one we talked about earlier of rates. A lot of companies and a lot of countries can sustain higher rates. The US has to be careful right now where we are with our net interest costs. Because sooner or later rates do drag on growth. And we're not there yet in the US, but I think other countries have a real issue where they may need to raise rates because inflation's moving up, and that'll be crippling, particularly some of the European companies.
And
China doesn't have that same issue because he can do what he wants and deal with the fallout later. And whenever somebody they're doing a renewed push against corruption there, which means that some people might be pushing back on Xi's power too. And they're still corrupt, but I think those types of things actually drive capital. And I think it's going to continue to drive capital to the US in the near term. But we have to get our house in order to keep it coming and keep our reserve currency status.
Well,
I do think one of the big opportunities globally, Mark, and I've neglected to mention this, and I thought about it with Wanda's question, is we're going to have massive rebuilds from climate, from wars. We have the Middle East that's going to have huge rebuilds. We have Ukraine needing a complete rebuild. You have all the places that have been damaged by wildfires, storms, hurricanes, earthquakes that are going to continue. And that just means more demands on governments. And that's going to mean more materials, more industrial support, more energy is going to be required for all that. So the opportunities are coming out of the problems as much as they are out of the innovation. And I think that's one of the things we have to look at is turning those problems into cash.
Any other questions, comments, thoughts, suggestions?
Quick comment is what you said, Stephen, our status as reserve currency is paramount. We lose
It
that.
is, but it's going to be, it can't be an autocratic nation to replace it. So then you look at the democratic nations and say, who's up? And who has the capital market system with the depth and liquidity to be able to deliver? And, at some point, we talked about this a little bit last week, at some point there could be a need for a debt jubilee globally. Because no one country can solve the problems of everyone else with the problems we have. I think we're a ways away from that, but a lot higher interest rates could really tip people over. And when you think they can't go a lot higher, remember we thought that housing couldn't have much higher default rates than they were experiencing in 07, and tech bubble was going to keep going on in 99, and a bunch of other things we thought would never change, and they all do. So I think just have to be careful, but I would keep an eye on rates, and I would keep an eye on what the Fed's doing, and whoever brought up the Fed balance sheet and Fed reserves, I think that's another area to really focus on.
Thank you, Stephen. Great presentation.
Thanks, guys.
Anything else?
Mark, next week I saw somebody come out with their black swans. They're not mine, but I'm actually in a time bind this week, so I'm going to use their black swans and then put it out for discussion for the group as to what they think's coming. Almost by definition, they're not, since they came up with them. But it'll be interesting to see what the world's worried about right now and how the community's views on that are. So
are you telling me that you're actually announcing the topics for the next 2 weeks? Black swans and immigration and immigration.
I believe I am subject to change.
Yes. Well, you're evolving in your
I'm actually in a time crunch, so I'm taking easy information and converting it as opposed to doing the heavy lifting.
Okay. Well, thanks everyone. Appreciate everyone's input. and we will see you next week.
And it's the input that makes the calls. So thank you guys. It really makes it a great conversation when everyone brings their perspectives. So thanks.
Stephen, thank you.
Thank you.
Thank you, everyone.
Thank
Happy
you.
New Year. Actually, the first one of the year too.
Yes, happy New Year, everyone.
Yeah, happy